The Italian government may have to step in to rescue Monte Paschi after the bank drops its last-ditch effort to bring in private capital. We'll take a look at why this could spell trouble for bondholders. Bank of America CEO Brian Moynihan weighs in on how potential changes to banking regulations could lead to large returns for his firm and the rest of Wall Street. And in a special sit-down with Bloomberg Business Week, JPMorgan CEO Jamie Dimon talks about Detroit's revival and his views on the incoming administration. We'll bring you that exclusive interview next. But let's get you started with a look at where the major indexes stand as we head towards the close. Abigail Doolittle is standing by. Abigail?
Hi there, Scarlett. Well, we are looking at small declines for the major averages heading into the close. The Dow, S&P 500, and NASDAQ are all lower. In fact, they are closer to the lows of the day than the highs, the very small losses, ever so slight losses right around the open. Needless to say, we don't have Dow 20,000. What we do have, though, is the Dow on pace for its first two-day decline since the election. So a little bit of a bearish streak here, very small declines over the last 2 days. Another first since the election potentially is the 10-year yield having its first weekly decline. This, though, does come in a big quarter for the 10-year yield. Here's a quarterly chart of the 10-year yield, up about 93 basis points. Its biggest move up on a quarter ever, just tremendous strength after the election, with investors thinking that the Trump administration could be good for growth, that there could be changes for the Fed. So very interesting there. But this could help to explain today's 5-year, $5 billion tip election, auction, excuse me. When we go into the Bloomberg and we take a look at G hashtag BTV 358, this shows us the history of the 5-year tip auction, and we see that the bid to cover a measure of strength is at its highest level since April of 2014. These are, of course, inflation-protected Treasury instruments, so they basically protect against the threat of inflation. Some investors fearing this with yields rising. But very interesting, inflation fears may be on the horizon, but we have another great chart that comes to us from Bloomberg currency strategist Vincent Signorella that suggests that those fears may be overdone. And this is G hashtag BTV 5456. In white, we have a 5-year inflation swap. This is basically a very forward look at inflation expectations. In blue, we have the 10-year yield. And Vincent Signorella says that historically, these swaps have led that the 10-year yield tends to trade up through them, then back down following swaps. So the inflation expectations are there, certainly, but it appears that they may be starting to diminish going ahead into the future, Joe and Scarlett.
All right, good stuff. Thank you so much, Abigail Doolittle.
Monte Paschi, the world's oldest lender, has abandoned plans to raise $5.2 billion from the market, making a state rescue more likely. Joining us now on the phone from Milan is Bloomberg News managing editor for finance and investing, Elisa Martinuzzi. Elisa, thanks for joining us. What's the latest with the troubled bank?
Well, we're getting, bits of news, incremental news as every hour. As you pointed out, yes, the bank has now basically effectively confirmed that it's abandoning plans to raise funds privately from the market. And that means it's abandoning its entire restructuring in the bank, get rid of a very large pile of bad loans, have some of the bondholders swap those bonds into equity, and last but not least, raise equity funds from investors. And so now really the focus shifts to the government, which is, we understand, is close to putting the final touches to a decree that would outline the method through which the government will step in to help Paschi, but possibly other lenders too.
Right, and the state rescue is likely. Is it guaranteed at this point? Is it just a matter of time before we hear from the Italian government?
Yes, it's not entirely clear, when that will be. We understand it's going to be, it's over the next few hours or a day. And that plan, that decree will give a sense for the kind of money, the kind of backup that the government is lining up, and could potentially give further clues as to the kind of hit that some of the bank's shareholders and bondholders will have to take, because under the existing European Union rules, banks can come in, but bondholders have to share part of the pain, part of the burden, and so that would possibly mean a hit and a loss for households that have bought the bank's debt.
Right. We heard a lot throughout this saga about European rules preventing a pure bailout. But to clarify what you just said, the rule allows for the government to come in, but there has to be some hit on the part of the bondholders?
That's correct, and typically it has to be accompanied by a restructuring plan for the company. So the bank will probably have to look at the businesses again, the operations, and figure out what the long-term strategy will be to make those viable. And there would be losses both for bondholders and for shareholders who would probably be heavily diluted by the new equity injection. And all this needs to be ratified by the European Commission. That needs to sort of validate that the plan doesn't create undue competition benefit for the bank.
How much concern is there on the part of the Italian Treasury about taking, essentially putting the bank's balance sheet on the public rolls? Already the spread of Italian government bonds is widened significantly over Germany, throughout this saga. Is there concern about essentially confidence in the state balance sheet as it takes a more active role in propping up the banking system?
Well, at the moment, there doesn't appear to be so much concern. I mean, the request went through Parliament. The request to increase Italy's debt by 20 billion euros went through Parliament pretty smoothly. But of course, what will be important and what people will be looking at is how these companies, which could include Paschi and other banks, will be managed in a situation in which they'll be owned by the government. Just what kind of form that will take, how quickly the government will seek to return those banks to private ownership.
And of course, Monte Paschi failing is not a huge surprise. It was the most vulnerable lender in the European Central Bank stress tests over the summer. I wonder, after the ECB told the bank to clean up its balance sheet, and it tried to but couldn't get anywhere, is there a role here for the ECB as we look to the rest of Italy's banks?
Well, of course, the ECB came in as a new regulator a couple of years ago, and it's gone through the books of the lenders, the bigger lenders that it looks after very closely, and it's put pressure on the industry, particularly in Italy, to clean up. And this is so that they can restore profitability, that it would restore the bank's health, with a view to lending again, which of course has been lending has been curtailed, and it's slowed down the economic recovery in the country. So yes, the ECB has taken a very active role.
Does the government of Italy hope that by getting this resolved, as you say, that it will be able to be a more active participant in stimulating the economy, get lending again, and ultimately help return the economy to health?
Yes, no, that's right. I mean, that's the ultimate objective here. And of course, the detail will be very important, as I mentioned earlier, how these banks will be run, what kind of restructurings they will put in place. There's been a lot of talk about the need for consolidation, for example, and the laws that the former Prime Minister had pushed through to make the cooperative lenders turn those into joint stock companies and push them to combine. They haven't really led to that consolidation yet. And some of those efficiency gains that could, restore the profitability and the health of these banks could come through that consolidation, which will potentially be part of the restructuring that we'll see later on.
Elisa, final question to you. Do we know what will happen to the CEO, Marco Morelli? His job was to crisscross the globe looking for investors to come up with this capital raise, and he's failed in that regard.
Yes, no, that's one question that we'll, hopefully have the answer to in the next few days, whether the bank will maintain the current management or maybe the current management will have to be reconfirmed. We just don't know yet. Of course, Morelli was brought in with what we understand was the backing of the Treasury at the time. So it is possible that he'll stay on, but it's just too early to tell.
All right, Lisa Martinuzzi of Bloomberg News, thank you very much for joining us.
And we're going to stay with banks. Some more breaking news, this time on Barclays, responding to the U.S. Justice Department, which is suing the U.K. bank for allegedly deceiving investors who bought mortgage-backed securities. Barclays is rejecting the claims made in the complaint. It says it intends to seek dismissal of these DOJ claims. So once again, Barclays intending to seek dismissal of the DOJ claims that the bank had deceived investors who bought mortgage-backed securities in the wake of the financial crisis. And this is something we'll be monitoring as the afternoon goes.
Coming up on What You Missed, we'll hear from a U.S. bank CEO, part of our exclusive interview with Bank of America Chairman and CEO Brian Moynihan. He'll tell us why mid-sized companies are, quote, friskier after Donald Trump's victory. This is Bloomberg. What'd you miss? Our exclusive interview with Bank of America Chairman and CEO Brian Moynihan from the company's Boston office. Bloomberg's David Weston asked Moynihan about the U.S. economy, specifically if he's seeing from his customers a fundamental difference in the economy rather than just a recent market rally based around hope.
Bank of America having, a fairly decent-sized customer base and seeing that $50 billion of credit card and debit card spending grow at 5% year over year and growing faster this time over the latter half of the year than the first half. Those are all very good things, and that means the economy is in good shape and it's grinding ahead and making progress. The difference after the election, especially, has been in the business side, the enthusiasm that. The world is our oyster, or whatever phrase you want to use, that just enthusiasm in mid-sized companies that they feel that there's just more they're going to get done, that they feel better about the prospects of the regulatory environment in their businesses. They feel better about the possibility of final demand. Now, that's going to take time to actually come through, but instantaneously the consumer confidence shot up and the business confidence shot up. And when you think about mid-sized companies, you and I own a company, we can decide to do something or not do something, build a factory, open a, and if we feel better, we will do it. And if we do it, that means things happen. What was happening before is people are hesitating, and now I feel, whether it's animal spirits as the phrase is used and things like that, I just feel people are saying, hey, let's go try it and see what happens.
And are you seeing that specifically in the mid-sized companies, the mid-level lending?
Yeah, we're seeing that lending grow. We're seeing it grew faster in the latter part of this year, drawing a little bit more on their lines, which means they're putting the money to work. But again, it's got to follow through because it's 6 weeks since the election or whatever, and the time frame's relatively short. But people forget how much attitude is important for that group of companies. For big companies like us, we always have to be swimming forward and doing something tomorrow. Every day, we got to figure out a way, no matter what the environment, we have to make more money, we have to get more efficient, we have to generate more revenue, take a little more expense out, apply more technology. That has to go on forever. Mid-sized companies can make their decisions differently because they're privately held, but when they are excited, that's very good for America.
Part of your job description is sort of being a macroeconomist of sorts, to understand what's going on in the economy, where it's
risk manager, probably than economist.
Okay, macro risk manager. As you look at macro risk, what are you anticipating in terms of the economy under Donald Trump? What do we know? What don't we know? What are the questions in your mind?
Well, I think, let's be first, what our team, we have the #1 research team in the world for 6 years in a row now. They just got the 6 years, so it's very
Congratulations.
Good. So thank you. So Candace and the team have the U.S. growing around 2% next year, which will be an increase from what they think this year will end up 1.5 to 1.7 or something like that, somewhere in that range. So that's an increase. And then the world in the low 3s, which again would be a step up. And so their fundamental belief of that hasn't changed a lot since the election. And so I think we believe the economy in the U.S. will grow, and we believe the economy in the world will grow, and it's a little bit more on the upswing. So they picked up, and it fell off this year, and we think it's back up. And so that part of that uncertainty that we went through this year has been handled by the markets and by people predicting outcomes, which is pretty interesting, between Brexit, the Italian referendum, the French election scenario to date, the U.S. election, all that stuff that people thought, if this happens, there's going to be huge disruption. The market disrupted for a few hours and came back and said, you know what, life goes on. So I think there's a tremendous momentum and capability and size that's behind this. So the question is, with Trump's election, as I said, businesses are friskier. They're more active. They're talking harder. You're seeing that go on. You're seeing the other thing, that the oil and gas business, because the prices come up, is starting to invest. The rig count's coming up. That's good for capital expenditures. That ought to help next year. You think the belief of our clients when we talk to them about regulatory burden is it will come down, and that will help them do things more quickly. So all that they believe is good. Now, there's other serious concerns. We have labor is trickier than people think. The unemployment rate's very low, so getting the right labor in the right place at the right time with the right train, kind of tricky for people right now. And yet there hasn't been great wage inflation, but largely it's the right jobs than it is, in the macro sense, a lot of wage pressure. So I think we'll be fine there, but we've got to do a lot of work to make sure that people are trained into it. But I think, the sole difference that happened, the big difference that happened in the last 6 weeks is the enthusiasm. And so if that follows through, it'll be interesting.
But I understood you to say that your research team, the #1 research team again, has not taken their GDP growth numbers up in response to Donald Trump. Have the markets then overreacted? Because certainly the markets have reacted as if GDP is going to grow faster.
I think this is one of those questions that you have to always ask. They actually took theirs down a little bit in the first half of the year because they thought the uncertainty around is tax reform going to happen, is repatriation, is going to have people slow down and wait to see what's going to happen. It's kind of an interesting viewpoint. I'm not sure they'll. It would be interesting to see how they think about that going forward. But that was one of their initial reactions: is the news could be so positive that actually freezes people. When people think tax reform is coming, they'll wait to see what the tax reform might say because they might be losing an advantage by doing something now. And so, there's always uncertainty. But I think they're fundamentally it's a solid U.S. economy. They're fundamentally it's a solid world economy, and the risk factors are gone out because the market's reaction to the election in the United States, the market's reaction to Brexit has been behind us. So they're saying, okay, that's not ahead of us. And there's still always another election, always another possible outcome. But I think they're very constructive. They haven't raised them because, in the end of the day, that is based a bit more on real items and real trajectory. And until confidence arises in more final demand and more spending and more activity, you're going to see it go on. You're going to see them keep it in the 2% level would be my guess.
And some people have said that the markets are sort of taking all the good possibilities out of what we've heard out of Donald Trump and are not really pricing in some of the unintended consequences of the bad consequences. Where are you on that? What are some of the unintended consequences we might not be thinking through?
Well, I think I'm not sure that you can say that any presidential candidate or elected president or president-to-be doesn't have the same problem, which is there's a series of things that have been prioritized or stated, whether it's tax reform, repatriation, immigration reform, Affordable Care Act, and things like that people are focused on. The question is now you got to get them done, and that's always the trickier element. Now, there's great view of alignment between the Senate, or the House, and the presidency will help that through, but that's the real trick. Can you get this done? And these things get harder when you get down to the brass tacks, and so they're never easy. And so I think the market's enthusiasm is at least they're going to try, and that's good. And then we got to see the follow through.
That was part of David Weston's exclusive interview with Bank of America Chairman and CEO Brian Moynihan.
And as we told you earlier, the DOJ is suing Barclays for its sale of mortgage-backed securities. Barclays says that it intends to seek dismissal of these claims and that it has rejected the claims made in this complaint. We'll have more on this developing story. This is Bloomberg. I'm Scarlet. What you missed, Barclays being sued by the U.S. Department of Justice for allegedly deceiving investors who bought mortgage-backed securities. The DOJ says more than half of the $31 billion in mortgage underlying the Barclays securities ended in default. Now, Barclays responded in the last few minutes saying it rejects the claims and intends to seek dismissal of them. Joining us for more context is Bloomberg's finance reporter Yaman Onran. And of course, Yaman, this was a surprise to everyone involved. What usually happens in these kinds of cases, and what's different this time?
It was a big surprise, big shock, because they always settle, almost always. Of course, it's not always, but typically, especially the mortgage cases, you know, the big mortgage crisis we lived through in 2008-9 with all these mortgage-backed securities blowing up, they have been settling. The big banks have been settling them one by one and paying lots of money in most of these cases. The U.S. banks have almost all settled. I think Bank of America has paid more than everyone else. Their total fines are now up to like $70 billion. But some of the Europeans have also settled. There are a handful that haven't, such as Deutsche Bank, that we all have talked about. You know, the starting point was very high, but then, you know, there's negotiation. This is unusual.
Do we have a sense of what the sticking point was? Was it price? Do they think the government's case is particularly weak here? What's the reasoning for Barclays?
So we don't know about the price as much as we know about Deutsche Bank. Somehow that one leaked at the beginning, right? We heard this $14-15 billion price tag, the asking price, the bid. Mm-hmm. And then there was debate, and Deutsche didn't want to pay that, but they're still negotiating. This case, we didn't hear the starting price, but what we know is that the bank doesn't want to pay more than $2 billion. So it must be way above $2 billion, whatever that number is. Maybe they start with 10 this time, and they could not come to the middle ground where that might be, or maybe the bank was adamant it was going to be 2. How the cases are different, why this bank thinks that they can win while the others are all settling, it's hard to tell. But, you know, typically it's not whether banks don't settle these things just because they think they're right. They settle because it's so costly and cumbersome and also uncertain for their shareholders to drag these on. They want to go for the certainty.
Is there any possibility that they want to kick this case into a Trump-led DOJ?
That's very, very likely, of course. I thought about that as soon as I saw the news flash across the screens. I thought, oh, okay, there's a new administration, which people think are going to be more bank-friendly. Bank stocks have been rising in the U.S. because Trump has talked about deregulation and other things. So a Department of Justice that's not as aggressive, maybe they think will not even pursue this kind of lawsuit, even if it comes. So this could be part of the equation.
Alternatively, maybe the DOJ was acting aggressively as a way to pressure Barclays to come to the negotiating table and resolve this sooner rather than later. True.
It could be. I mean, you know, there's a few weeks left, and maybe that's what's going on.
All right. Thank you so much. On this breaking news, Bloomberg senior finance reporter Yaman Onran. Again, Barclays intending to seek dismissal of the DOJ lawsuit alleging Barclays deceived investors who bought mortgage-backed securities. The market close is next. Take a look at the major indexes with less than 4 minutes to go before the close. We do have declines here in the Dow, S&P, and Nasdaq, so no record high today. But it's been a quiet trading day overall as investors get ready for the holiday weekend. From New York, this is Bloomberg. Moments away from the closing bell. What'd you miss? U.S. stocks pulling back this Thursday. The post-election rally starting to ease a bit as we head into the holidays. I'm Scarlet Fu.
And I'm Joe Weisenthal. We want to welcome our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. We have 7 out of 11 major groups in the S&P 500 down. So as you might guess, U.S. stocks kind of sagging into the close here on some very light trading. There was a mess of economic data, Joe, but it didn't seem like anything really catalyzed prices here.
No, it definitely wasn't the big action today. In fact, the only thing that really moved markets, and it was only brief, was Donald Trump back to tweeting again, moving stocks. We have a tweet right here where he mentioned the United States must greatly strengthen and expand its nuclear capability until such time as the world comes to its senses regarding nukes. Content aside, it's kind of interesting when the president is tweeting about nukes, and it actually moved uranium stock.
It did. If you look at URA, which is the ETF that tracks these kinds of companies, it briefly turned positive. It did still close down 0.5%, but certainly pared its losses. And the other names you can see moved higher. Uranium Resources, Uranium Energy Corp, and Cameco Corporation all turning higher. Look at that 31% gain.
Huge move. Of course, it's a $1.43 stock, but still.
If you look at the S&P 500 in terms of sectors here, if you check out IMAP Go on the Bloomberg, what you'll see is 4 out of the 11 industry groups rose. So you've got telecom, energy utilities, healthcare. So maybe a little bit of a move into some of the more defensive names like telecom. But telecom has been its own special category recently because of hopes that Donald Trump with the new FCC and everything will kind of change the fortunes for this sector. In terms of decliners, consumer discretionary, that's your retailers, your home builders, your car makers, materials and tech shares were the leading laggards. For the Dow, this marked the first back-to-back decline since before the election, since November 4th. Hard to believe.
That is a crazy fact. Real quickly, looking at government bonds, another quiet day. We see yields in the U.S. totally unchanged on the short end and on the 10-year, up 0.02%. But despite all of the economic data this morning, which was overall pretty good, not a ton of action on the rates front.
Not a ton of action in FX either. Fairly muted trading. We could start with the euro because it had risen after Jens Wiedemann of the Bundesbank cautioned the European Central Bank not to raise interest rates too late, not to wait too long. But you can see that that was pretty brief, and the euro-dollar rate was actually capped at around 105. Dollar also getting a boost after the GDP revision for the third quarter came in higher than expected, but then we saw the gains kind of fizzle out after the income and spending data missed estimates. So you can see how the dollar really didn't have that much momentum versus the yen, versus the pound as well.
And finally, on commodities, let's take a look. We have the only real mover today was coffee. It was down nearly 4%. That was on some news about Brazil perhaps stepping up its production of coffee. So you see a real sell-off there. Otherwise, kind of like everything else we're looking at today, not a lot of volatility anywhere. You can see crude oil and gold hardly moving at all.
Kind of soft all around. Those are today's market minutes. We want to take a deep dive now into the Bloomberg. You can find all our charts at the function, using the function at the bottom of the screen. So I'm going to stay with the economic theme here because we are starting to see a pickup in manufacturing sentiment. The latest regional surveys from Philadelphia and New York show optimism for CapEx and future orders are rising. And what you'll pay attention to here is that tick higher right at the end of the chart, whether it's the Philly Fed or the Empire State CapEx or new orders outlook, it doesn't really matter. This white line here, which is the Philly Fed CapEx outlook, is at a 17-year high. The red line down here, the Empire State new orders outlook, at a 2-year high.
You know who else is feeling good besides manufacturers? Republicans are feeling really good about the economy. I'm looking at the Bloomberg Consumer Comfort Index, and it's really great because it breaks down sentiment about the economy via party. And the way Republicans feel about the economy is now at its highest level since early 2008. And if we zoom in here, look at that. You can just see it absolutely exploding since the beginning of November. So it shows how one's partisan affiliation has an effect of shading one's view on the economy. And it may not be completely irrational in the sense, look, if you're a Republican, you probably believe Republican policies are going to be better, so you might feel more stable. But it really is striking. Democrats have come down, though not quite as dramatically, but it really is striking how much their sentiment
how
about
pronounced it is.
How pronounced it is right after the election of Donald Trump. Here now to talk about all the data and what's ahead for the new year, we have Carl Riccadonna, chief U.S. economist for Bloomberg Intelligence, and Vince Signorella, Bloomberg's FX strategy and a former currency trader. Carl, I'll start with you. Survey data left and right is surging, whether it's Bloomberg Consumer Comfort, the expectations components of the manufacturing surveys, NFIB, NAHB, UMISH, everything where they ask people how they're doing is surging. Is it going to translate in the coming months and quarters to hard activity picking up?
That's the critical question. So as we look at, for example, the manufacturing surveys that Scarlet had on the screen there, we see expectations for orders moving higher and CapEx plans moving higher. The employment components have been on the soft side. So that's kind of where the rubber meets the road. It's great to feel more optimistic, but your money's where your mouth is when it comes to actually hiring new workers. So this will be a critical test for the economy, I'll say, in the first quarter of the year, because I don't think this euphoria can hold up if we're looking at tepid economic gains.
And euphoria really has been driving the markets, Vince, although we've seen some of that euphoria come off a little bit here in the last couple of weeks. The dollar has not been making as strong gains as it had been.
We're running on a little hopium going into the into the end of the year and into next year. There is a tendency for the dollar, if the way it surged so much, to slow down, to peak into the year-end. Trading volumes down substantially. Talking to traders over the last few days, the words are apathy, lethargy, and leave me alone. They definitely want to get into this holiday weekend and just kick it off.
Do weird things ever happen over the next several days as people leave and not much volume and news happens? Like, what does history tell us about this weekend?
There's a sound whoosh that can happen in currency markets at this time because of the lack of liquidity, especially now where, back then traders would step in and fill the gaps when they would occur. Now with the machine-driven algo all pushing things in one direction and traders not being able to take positions, there isn't the same type of liquidity to catch these free falls and flash crashes, et cetera, that can happen. So next week's primed for that opportunity.
Could be fun.
Okay, so there could be a lot of dramatic moves, but in the meantime, the dramatic move has been in the dollar, which has definitely moved to the strong side over the last couple of weeks since the election. Carl, at what point do we presume that the stronger dollar is going to bite into exports and really show up in the data, show up in earnings, and take us down a notch?
Sure. Well, one of the first places it shows up is in the new export orders component of the ISM survey. I've been watching for it to show up in the last couple of months, and it hasn't. That part of the survey has been very resilient. Normally, it's a very tight lag time, right? And we've seen dollar appreciation really since this summer. So I've been watching for it to take off. It hasn't happened yet. So that's kind of the canary in the coal mine that we should all be keeping our eyes on. And this is a Fed that is very sensitive to moves in the dollar. Janet Yellen, Lael Brainerd, they are paying very close attention to currency. It led them to delay liftoff, if you remember, all the way back to March of last year.
Right.
And it has been a persistent factor leading them to move more slowly once they finally did lift off.
From time to time, it can appear that good news is bad news if strong economic data has the effect of causing people to believe that the pace of hikes is going to be faster, which is theoretically bad for the market.
Right.
Are we close to that if we keep getting data like this, or are we closer to Goldilocks data, where if we keep getting data like this, it shouldn't cause too much of a jostle?
I think we need to see a real rewriting of expectations for growth. And if we're looking at next year and folks are only anticipating 2.5% real economic gains, then I don't think that good news will be bad news. As you say, if it suddenly looks like, oh, we're getting to 3 or 3.5% growth and we're going to have a big flare up in inflation pressures as a result, then that's going to start to change the way the market's reacting. But as of now, mind you, even after that strong Q3 GDP number, we're still at less than 2% growth in year-on-year terms, which is what really matters for the inflation outlook.
That's some good context. So as we wait to get to the point where good news can actually be interpreted as good news in the U.S. economy, Vince, with the European Central Bank and the Bank of Japan still in very, very accommodative mode, and that's not to say the Fed has moved into a supremely tightening mode. It hasn't. It's just less accommodative.
The Fed governors think so. They're looking for 3 hikes next year.
3 hikes hikes. Wow, 3 hikes. Having said that, are we still looking at bad news as good news overseas?
The one thing first to Carl's point and where the dollar goes and what the Fed folks are looking at. What traders look at is essentially a 4% move in the trade-weighted dollar index translates into roughly 25 basis points of tightening by the Fed. So if the dollar does continue on this trend even more aggressively into 2017, you might want to step back some of those rate hikes because they'll actually be essentially priced in with the dollar.
Outside of the Fed, there's other policy in the world now. The Fed is not the only actor. Fiscal policy, as well as perhaps changes about trade policy, taxation. What are you looking at are going to be the big stories for next year in terms of how, what the Congress could do to really sort of reshape the U.S. economy?
Sure, absolutely. So, as we look at the first 100 days, there'll be some deregulation issues and whatnot that will help specific sectors. But in terms of moving the needle on the macroeconomy, I don't see it having a big effect. And so what I'm watching for is the timing of the implementation of Trumponomics. Now, they could make, there's likely tax cuts coming down the pike, both corporate and income tax cuts. The question is, will they make them retroactive to the start of the year, or will the negotiations proceed and take so long that they say, well, let's just start it at the beginning of calendar year 2018. Similarly, for ramped up government spending, be it on defense or infrastructure spending and whatnot, that would likely come at the beginning of the fiscal year, which is October 1st. So, as we think about Trumponomics, my view is this is more of a 2018 story than a 2017 story, unless they start doing things like making it retroactive. But you don't do that when you're not in economic crisis. So there's the luxury of time in this case.
All right. Thank you, Carl Riccadonna, Chief U.S. Strategist for Bloomberg Intelligence, and Vince Signorella, Bloomberg's FX strategist.
Coming up, are we seeing a Reagan administration redux in the stock market? We've got the chart that shows history may be repeating itself and not necessarily in the best of ways. From New York, this is Bloomberg. I'm Courtney Collins. Let's get to Bloomberg's First Word News this afternoon. A State Department official says 2 U.S. citizens are among the 48 people injured in the attack on the Christmas market in Berlin. 12 people were killed. The Berlin market reopened today with extra security. Meanwhile, a German minister is confirming the fingerprints of suspect Anis Amri were found in the cab of the truck. Officials are offering a $105,000 reward for information leading to his arrest.
A U.S.-based Muslim cleric is condemning the killing of Russia's envoy to Turkey. Fethullah Gulen is also denying accusations that his movement was behind the attack. Ambassador Andrei Karlov was murdered Monday in Turkey. Turkish President Erdogan has implicated Gulen in the killing, accusing his movement of having ties to the gunman. And the Obama administration is officially ending a post-9/11 era registration system for immigrant men who come mostly from Muslim countries. The decision to scrap the system comes at a time of growing international terror fears and President-elect Donald Trump's suggestions that he could ban Muslim immigrants from the United States. The administration hasn't been using the program since 2011. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Scarlet?
Thank you so much, Courtney. What'd you miss? The Trump rally is showing similarities to the Reagan rally in 1980, at least in equities. Take a look at this chart here. After the election of Ronald Reagan, the stock market rallied 9% into late November and then sold off heading into early December, giving up all of the election gains. In 2016, we're seeing a rally post-Trump victory. But the question is, will it be short-lived or will it continue?
Joining us now, Peter Cecchini, Cantor Fitzgerald, co-head of U.S. equities and chief market strategist. So, will it continue? I'll just start right there.
Well, it's interesting. We don't think it's going to continue in the intermediate term, albeit it's difficult to say what's going to happen over the next week, right, into the end of the year. The question I always get, will it continue in the,
what
through
about
January
like 6
1st?
months from now? Are we going to be higher?
We don't think so. We actually do think, we agree with your chief economist that we don't think the impact will be quick enough or great enough to actually change the macroeconomic fundamentals all that much. And right now, really, the rally is all about sentiment rather than the reality.
So you are not a buyer of this whole reflation story, and you see the dollar as a huge drag, and
Yes.
you don't really see how the current growth and inflation initiative really plays out. Why is it that so many people are so eager to jump on it then?
Because it's a very, very sexy and seductive narrative, right? We all want to believe that things are going to get better. We've had a lackluster recovery for years. The market has done quite well, but the Fed has obviously been very accommodative, and now we have other central banks that are accommodative. But we really have not had a great Main Street recovery, and I think people want to come around to the fact that we're going to get one.
You know, this is the part that's confusing me, too, because we've had this incredible market rally starting in March 2009, over 7 years old now. So it is a little weird that after 7.5 years, suddenly, we're getting really bullish, excited about this market. It's like, where have you been? Not you.
Right.
But
No,
all
no.
these, like, people who are getting all exuberant.
Exactly. Well, I try to, in our work, we try to key off the credit cycle, and I've talked about this before with Scarlet. And it was very easy to be bullish in 2014. The credit markets looked great. We had great growth. Earnings were growing. 15, there was a bit of a shift afoot. We were much more cautious. We were neutral on U.S. equities. For 16, we were actually quite bearish, and it hasn't quite played that way. But all of the conditions are there for us to be very cautious. That is to say, lending conditions are tightening. When you look at the Fed surveys, for example, so loan officer surveys, that's been 4 quarters of tighter lending standards to commercial and industrial buyers. We've seen a quarter of tighter lending standards to consumers. And now we have a Fed that is starting to raise rates, albeit very slowly and in a very measured way. But the fact of the matter is, we have much tighter financial conditions coming forward.
So have Treasury yields been rising unjustifiably then? I mean,
yeah.
So what's been moving it higher? It can't just be the election narrative, because they had been moving before the election.
Right. I agree. Rates had been moving before the election. So we've actually been really focused on the relationship between the Bund and our 10-year. When you think about who the major actors are, we had the Fed. The Fed was the major actor. Now the major actor is the ECB. That is OMOs on the long end of the curve. The Fed stopped doing that in 2014. Now the ECB is doing that, and frankly, just recently announced what I thought was a very, very dovish go-forward strategy with respect to Bund. So when the Bund yield comes down, when rates come down in Germany, that tends to anchor U.S. Treasuries. And that kind of makes sense conceptually, right? If you're a pension fund manager and it's within your mandate and you can buy Treasuries at 2.5% and a Bund only gives you 30 basis points, which would you rather own, assuming you can effectively hedge that?
Right.
You'd rather own treasuries. And so now, right now, we do a dislocation analysis. That's one of our most dislocated relationships going back to early 2014. Treasury rates are way too high relative to the Bund yield. And we think the reversion is going to come from Treasury rates coming down rather than the Bund rate rising.
And if we look in this chart in the Bloomberg, it's just comparing treasuries to treasuries here, but it shows how much rates have lifted across the entire curve since that election. It's funny because here's another theme. Suddenly everybody now thinks this is going to be meaningful reflation, higher yields. Where do you see rates going? Back down to the lows, 2%? Where do you see the 10-year heading?
Certainly not back where they were. I think they got down to 136 mid-year. Our forecast for this year is between 1 and 2%. Pretty broad range, but that's kind of what's happened. Now, I'm not in the 3% camp because I think that really does take fundamental progress and inflation that we're not going to get. Scarlet, you mentioned the dollar. How can we really, with a straight face, talk about a reflationary theme when the dollar has broken out of its recent trading range almost against every other cross? It doesn't resonate with me.
Very refreshing to hear an alternative view, because we just get one person after another
who's bought into it.
Everyone's on that 3% number because everyone seems to be clustering around that.
So here's another question. I mean, we're talking about Donald Trump's posturing on China, calling or threatening to call China a currency manipulator. You're saying that that's having an impact on the markets as well, because you believe that China has been selling treasuries in anticipation of being branded a currency manipulator, and that's helping to drive those yields higher.
Yes. As you mentioned at the beginning of the segment, rates began to rise long before Trump came into office. And again, that was around, we think, the two things, the Bund and China. China has, as we know, been selling treasuries for some time. But if you look at the data, it's actually accelerated around the election. And the way the 2-year moved relative to the 10-year, the day of the election, actually suggested that there was a large seller out in the market. So, yes, we also think that is a factor that's helping to lift the long end of the curve a little bit. Again, an alternative causal explanation for higher rates.
So if your thesis plays out, when do you see things falling apart? What's going to be the catalyst?
That's a wonderful question, and I wish I were smart enough and good enough to really give you an answer to that. However, we did talk about the Reagan redux and the analogy, and every analogy fails at some point, right? I think it's going to become clear to investors at some point that valuations aren't coming down, that growth isn't accelerating to the extent that people think it is, and that financial conditions are, in fact, tighter. Now, how long does that take to bleed through the euphoria of a new president who is pro-business? I'm not really sure. If I had to venture a guess, it is during the first quarter, and perhaps, within a month or two.
All right, well, we'll have you back, and I'll see how it goes. Peter Cecchini, Cantor Fitzgerald, co-head of U.S. Equities and chief market strategist. Thank you very much. And coming up, when this celebrity's weight goes down, this stock goes up. Do you know the answer? We'll tell you next. This is Bloomberg.
I'm Scarlet Fu. What you missed, Beijing suffering another smog-filled December. So let's take a deep dive into the Bloomberg. You can find all these charts using the function at the bottom of the screen. And this is a way of measuring air quality in China. And what we've done is include different cities. So it's not just Beijing, but also Shanghai, and Guangzhou. So Beijing is the white line, Shanghai is the green line, Guangzhou is the blue line. It really doesn't matter which city you're looking at when you notice that there's a distinct pattern here, right? The pollution is always an issue in the winter. You can see the peaks every year. They head into the hazardous levels, which we've marked with the red shading. And it's a problem because last December, China issued its first ever red pollution alert. It did it again this month. And this is a socially important issue because it causes social unrest. China has more pollution-related deaths than any other country. And it also means that foreign companies, or companies in general, have a hard time attracting talent.
Because who wants to live in that?
Exactly. Who wants to live in that when you can go somewhere else, when you can go to Singapore, for instance? So it's a big issue. All the state governments need to dance around whether they're going to pursue growth or whether they're going to try to keep a lid on air pollution.
Also, pretty awesome that we can chart that so easily.
I know, right? And it goes back to, what, 2013, end of 2012.
All right, here's another thing that we can chart, and it's the relationship between shares of Weight Watchers and news about Oprah Winfrey gaining or losing weight.
You're
of course,
kidding.
she is a while back, she took a stake in Weight Watchers, and the idea was that she was going to promote the company, and that it caused the stock to surge. It's been sort of languishing lately, but today came the news that Oprah says she's lost 40 pounds, and if we zoom in, we can see the massive move up today. Inverse effect of her weight. The stock was up about 20% on this news that she had lost 40 pounds. So kind of a reminder that she's still invested in the company, promoting it. And obviously, if you're sort of looking at this as evidence that the Weight Watcher system can help people, then there you go. So.
But, you know, her history, her track record with her weight is that it's very up and down.
And if we could zoom back a little bit further, we could see right here in, I think it was October 2015, when it was announced that she first took the stake and the stock surged. But it, you know, it hasn't ultimately done very much for the stock because it's been sliding back. But
it's still higher than where it was.
It's still higher than where it was, and sort of an interesting relationship between various events. And,
I love this. Dan Curtis, thank you so much for putting this together. All right, coming up next, we're going to ask JPMorgan CEO Jamie Dimon what he thinks about loosening business regulations. Our conversation with him next. This is Bloomberg.
I'm Courtney Collins. Let's get to Bloomberg's First Word News this afternoon. First up, a statement by the Syrian armed forces says the northern city of Aleppo has returned to government control. That ends a 4-year rebel hold over parts of the city. The army said it has reestablished security after the last rebels evacuated from their final toehold in the eastern parts of the city. The recapture of Aleppo represents a momentous victory for President Bashar al-Assad and a crushing defeat for Syria's opposition. The ancient city has been divided into rebel and government parts since 2012. A vote on a United Nations Security Council resolution criticizing Israeli settlements in the West Bank has been delayed. That's according to the UN Media Liaison Office. Earlier, President-elect Donald Trump called the resolution unfair to Israelis, saying it puts them in a poor negotiating position. The U.S. has historically vetoed resolutions seen as hostile toward Israel, though the Obama administration did not say how it would vote in this case. Chancellor Angela Merkel says she's proud of the German people's level-headed response to the Berlin truck attack. She arrived at the Federal Criminal Police Office in Berlin today for an update on the investigation. Merkel's foreign policy has come under further attack as she prepares to run for a 4th consecutive term. Germany took in more than 1 million refugees in 2015 and 2016, most of them from Syria and Iraq. And President-elect Donald Trump is suggesting the U.S. must greatly strengthen and expand its nuclear capability. Trump tweeted that the U.S. must bolster its arsenal until such a time as the world comes to its senses regarding nukes. During the campaign, Trump suggested that the U.S. expand its arsenal and mused that the world would be better off if other countries, including Japan and South Korea, had nuclear capabilities. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Scarlet?
Thank you so much, Courtney. Let's get a recap of today's market action, or perhaps lack of action. We have U.S. stocks kind of swooning into the close here. They were kind of under pressure all day long, and if you look at the actual industry groups, not a whole lot of movement there. It's been kind of back and forth. Certainly people are trying to close out their positions. No one's really that excited to take up new positions at this point.
Yeah, not a lot of action in any of the various asset classes we look today, and yet another day of waiting for Dow 20,000.
It remains as elusive as ever.
What do you miss? President-elect Donald Trump promised to crack down on undocumented immigrants during his campaign. Since he was elected, he's softened his stance, but his policies could still have impact on business in this country. In an exclusive interview in Detroit last week, Bloomberg Businessweek editor Megan Murphy sat down with Jamie Dimon and asked about the rhetoric in the run-up to the elections and how he expects American immigration policy to change.
The rhetoric, which I thought was terrible in the election. I go to JPMorgan Chase and, kind of with that letter, I tell people if you're black, Jewish, LGBT, African American, or a woman, we're going to support you in that kind of diversity just the way we did before. Okay, that's not going to change anything here. And in fact, I think you see the rhetoric, it seems to have gone away. Even the rhetoric about immigration, President-elect Trump, or I think is sounding a lot different than candidate Trump, has now said that if you break the law, we're going to deport you. And they estimated the 11 million undocumented, that only 800,000 had broken the law. And by the way, that is the current policy of the United States. President Obama deported 2.8 million people, I think, for breaking the law. So, but absolutely, the Business Roundtable has already supported immigration for that very reason. It is a pro-jobs, pro-argument, and it's also respectful. The fact is, most people, when they get worried about immigration, it's not necessarily that they don't like immigrants. It's more, sometimes when you look into it, they're more afraid that the American way of life is changing. So you could be multicultural, but still support the American way of life. You remember Abe Lincoln, we're here to rededicate ourselves for this nation, conceived in liberty and dedicated to the notion that all men are created equal. This is the only nation on the planet that was an idea. It was a vision, it was a value, it was not a tribe. Okay, and so I think it's and that a lot of people want to make sure that doesn't change, and that some people are confusing multicultural, that somehow we're going to change, that we won't tolerate different religions, that we won't tolerate different opinions, that we won't tolerate free press, and that, honestly, so you could support that and be multicultural.
Absolutely. But when you travel in sort of Europe, where this is also a very deep phenomenon, we see it in Italy, we see it in Germany, we see it in France, we see it in the UK, to be sure, obviously with Brexit. Do you think this is a temporary phenomenon in terms of how people are feeling? Do you think it's a generational phenomenon? Do you think that it will essentially weed itself out? Or do you think this is a really permanent movement of people who are more focused on redrawing sort of national borders, national identity, regrouping around that in what has been a decade of constant, more than a decade, 2 decades of constant disruption across so many stabling forces in their lives?
So remember, when you look at something like Brexit, there were completely different forces for Brexit. Some were anti-immigration, some were they want open and free trade, so all these people voted for it for a whole bunch of different reasons. And I do think if you go to Europe and part of Britain, there is the same frustration about income inequality, about growth in wages, about lost jobs. If you go to parts of Europe, 25%, so it's not the UK, not Germany, but 25% of people between 21 and 35 aren't working. Is that a sustainable thing if you have another generation of that? So I think there's a legitimate frustration about why is that? How did that happen? And a lot of it is government policies, by the way, so there is frustration. A lot of you saw it in America, and you see overseas is, I want it changed. They want a wrecking ball brought to these governments. They want change. They weren't necessarily voting for a lot of things people said. They want something very different than they've seen, and a lot of us are sympathetic with that. We want to see something different. We want things to be better. And again, ultimately, you have to have facts, analysis, and real detail to make that happen. Populism itself can be very destroy things, because look at Venezuela, Cuba, Argentina, which is now going the other way. The other thing about Europe, just keep in mind, we talk about all this disruption. They've had, since World War II, peace. They didn't have peace for the 2,000 years before that. So there are benefits that people are reaping. Maybe they forget about it, but it's important to have peace in Europe, too.
As for Donald Trump's pledges to roll back some regulation, Meghan Murphy asked Jamie Dimon how he sees that playing out in the next 4 years.
JPMorgan didn't jeopardize the system. We did not cause the crisis. We did not need TARP. And we have 3 times more capital than we had back then. Okay? We didn't lose money. How much do you think we lost in the 9 quarters after the Lehman crisis? And people guess $5 billion, $10 billion. We made $20 or $30 billion. We were not jeopardizing anyone. In fact, we helped. We bought WAMU, we bought Bear Stearns, we saved 30,000 jobs. In doing so, we helped governments, cities, schools, states, hospitals that probably wouldn't have survived but for JPMorgan stepping up to do something well. But I understand the concept. The American public saw a disaster. It wasn't their fault, and generally it was Wall Street and Washington. And they absolutely have the right to say, we want a safe and sound banking system that doesn't cost me money and doesn't take down my economy. Those are true. That does not mean, it's a false lie to say, therefore all of these rules and regulations are good. They're unrelated. So the American public's been told that whatever bank wants, don't do it. Any, strengthen Dodd-Frank. That's not accurate, okay? Some of these things, a lot of the things in Dodd-Frank had nothing to do with the crisis. I mean, zero, nada. They were just the pet peeves of certain Democrats who just put things in because they felt like it. Someone said to me once, anything that has the name of a senator on it, that was their bad part. Like Barney Frank and I agreed on some of the things that should have been in there. Anytime you've done major legislation and major regulations, and they're different, by the way, it's perfectly reasonable for people to look back, reanalyze, recalibrate, think it through, talk about what good it did, what damage it did, how we can help. Folks, we have not solved the housing market with mortgages. Because we haven't solved that issue, which is among 7 agencies or something like that, banks and other institutions are afraid to make mortgages to first-time home buyers, self-employed, or people who had a prior bankruptcy. Now, people who had a prior bankruptcy, 80% of the time is perfectly legitimate. There's nothing wrong with them. It was usually due to death, divorce, disease, loss of job. Not in one case was it you would say there's a bad person. They deserve a second chance. We haven't fixed that. I would look at some of the rules and regulations of reducing credit available in the system, but they do not create more safety and soundness. And I don't want to bore you with the details about that. So Dodd-Frank isn't the Bible. Okay? And, to me, matter of fact, even Chuck Schumer used to say to me, look, eventually these huge legislative will be opened up and we'll relook at it, recalibrate it, synchronize it, reduce the negative parts of the cost that has no benefit, while still accomplishing the ultimate goal. So it's a perfectly reasonable thing to look at these things and try to figure out what you can do better, as opposed to a knee-jerk reaction. Everything that was put in place was good.
Talking about minimum wage, that's been one of your big pushes, and you believe it's vital to growth as well. And as you said, you've moved up at JPMorgan. We now have a nominee for Labor Secretary who's been one of the most open advocates against raising the minimum wage. and has been quite firm about that.
I don't think so, because what I read, what he said is that the government should be very careful about raising its minimum wage too high. It should be a decision made at a local level, because you all, a lot of businesses, can afford. California and New York can afford $15, New York City, but upstate New York probably can't. Okay, so I think he was saying that he's not against states raising it thoughtfully that it can help people. I'm kind of in favor of that. I would be not in favor of the federal government doing it and imposing real hardships. But the other thing is, if you can afford it, I say if you're a business that can afford it, raise it. Share the wealth a little bit. Okay? I tell the people at JPMorgan, I'm more worried about the pay of our lower paid people than our higher paid people. So, but the other thing is to help society is the earned income tax credit. That's my example is that will help small business. So if you're a small business that needs wages at $10 an hour to get by, and you can't afford medicals, I'm not saying you're a bad person, but that's how you survive, then this will really help you. You can attract better people, they'll be paid more, you'll probably have less attrition, and allow you to maybe afford more benefits over time. So there are solutions to this. And us raising it is just a teeny piece of it.
That was Bloomberg Business Week's Megan Murphy with Jamie Dimon last week. And you can watch the full interview on Bloomberg Business Week Debrief, a conversation with Jamie Dimon, tonight at 9 p.m. Eastern, only on Bloomberg Television.
Coming up on What You Missed, thoughts from longtime Donald Trump supporter and Colony Capital founder and CEO Tom Barrack on Trump's tweeting style and Rex Tillerson as the nominee for Secretary of State. This is Bloomberg.
What you missed, longtime Donald Trump supporter and Colony Capital founder and chairman Tom Barrack is leading the presidential inaugural committee. Earlier today, he spoke with Bloomberg's David Gura and was asked whether Trump's tweets are too reactionary rather than thoughtful opinion put out only after introspection.
I can assure you one thing, that this president-elect does nothing based on instantaneous temperament. And that before he tweets, before he reacts, he has a constituency and a group of people who have the expertise around him to advise him on the efficacy of of that statement. Now, the efficacy of whether he should tweet or not tweet is a different debate. But he's probably one of the most open to various points of view and countering points of view. If you look at his choices in the cabinet, if you look at the choices of his staff around him, he encourages debate. And I think you have a very safe and confident set of hands. We're just learning a different communication style. And that communication style is transitioning from campaign to presidency. So we were also shocked in that communication style in a campaign. And I think the training of that shouldn't be interpreted as spontaneous or not well thought or considered. He's a very thoughtful man. He's got a great group of people around him. He's not going to do anything abrupt.
Tom, let's talk about that group of people, some of the men and women that he's picked for jobs in the White House. We'll start with Rex Tillerson, the head of ExxonMobil, who's been picked to be a Secretary of State. What can we read into that pick? We've been talking about Russia. We've been talking about the nuclear arsenal. A lot has been made of Rex Tillerson's relationship with Russia and the Russian president. Should this indicate to us that when you look at the foreign policy brief for the next president, Russia is going to be highest on the agenda?
Well, look, I personally, Rex Tillerson, I think is one of the best picks possible for that position. And let me just give you the preface. Is if I were going on a safari in Africa and I have lots of choices of who to lead me through the jungle, I'd pick somebody who had been through that jungle 1,000 times, right? I mean, that would be the number one qualification. So part of the criticism of Rex is that he knows most of the world leaders. He knows Putin. He's dealt with the Arabs in energy and oil, and he's got relationships. So when you move aside any potential conflict of interest, which will be handled by a very buoyant Senate confirmation process, you have somebody who knows the hardware, who has the cultural adaptability, who understands the history of all of these regions, and who's been there, running a bigger organization than the State Department. Right? What he's run is much bigger than the State Department. So I think the warrior himself is perfectly sculpted for the job. Now the question is, with the relationship with Putin, is that a good thing or a bad thing? In my opinion, it has to be a good thing. Put aside whether we're soft or hard with Russia or soft or hard with the man. Having somebody that has experience with him, that's dealt with him on a business basis, that understands the history of Russia, that understands the ideological components of Russia, can only benefit us when, in the Middle East, for instance, we have to come to some alliance with them in order to find peace in Syria, for instance. So that dialogue isn't based on his point of view. That point of view is going to be digested by Congress primarily. The president will present a vision, and Congress will agree or not agree. But out in the field, in that jungle, you couldn't have a better athlete than Rex Tillerson leading a foreign service operation and a bureaucracy which he knows and understands.
We've talked about the novelty of his communication strategy, and I say novelty there meaning the newness of it. Let's talk about Donald Trump's diplomacy. Can Rex Tillerson, if confirmed as Secretary of State, expect that there will also be messaging from the president that could at times run counter to what he's pursuing? He'll be somebody who, in concert with Rick Perry, should he be approved to be Secretary of Energy, have to deal with the issue of nuclear weapons, say. How unified is the message going to be?
I think what you'll find is that it'll be terribly unified, because one of the first tasks of this president is to unite the constituencies that were never Trump, right? The forever Trump constituencies he knows and he has at hand. The objective now is, as president of all the people, you need to incorporate all of those points of view. And that includes bringing all the points of view of now the advisors that he has the resources to bring in who are better than him in those individual disciplines. So, and that's been his task, right? As a builder, as a developer, he's gone out and hired the best architect, the best contractor, the best sculptors, the best of everything, and orchestrated them together. It hasn't been his vision alone. It's been this beautiful melange and a symphony. And I think you're going to see him build symphonies, not dictate his own personal points of view. It's not his style.
That was Colony Capital founder and chairman Tom Barrack.
Coming up next, we'll take a look at oil and a few subsectors that you should be watching for in 2017. From New York, this is Bloomberg. I'm Scarlet Fu. What'd you miss? Bloomberg Intelligence has released its 2017 outlook, and each day this week we've been taking a look at what you can't miss in different sectors for next year. Today we're looking at energy, especially onshore and offshore drilling. Joining us now is Bloomberg energy analyst Andrew Cosgrove. Andrew, give us your best sense of what investors should be watching for 2017.
Thanks very much. Yeah, so for next year, I mean, the focus this year in the oilfield services subsector was U.S. onshore. Usually the beta play, it has been that in previous recoveries. Typically land drillers or pressure pumpers such as Helmerich & Payne or Nabors or Patterson have been the winners, but frac sand stocks such as U.S. Silica, Fairmont Central were the winners this year. As you go into next year, there are beaten down sectors that have been out of favor for quite a long time. They include offshore drillers. And if you do get some sort of sustainable oil price environment next year, it is something or a particular subsector to think about looking at as you move throughout the year.
What are the key regulatory things to watch now that we have a change in administration? What policy moves could have an impact on those drillers?
At least from here in the U.S., I mean, certainly there's really not too much in the near term. If you're going to continue to open up places for U.S. onshore, potentially more natural gas development, you've seen the back end of the natural gas curve kind of shift to lower as a result of Trump coming in and potentially, increasing or letting more drilling happen, so to speak. From an offshore standpoint, nothing really changes from an investment thesis because most of the outlook so far has been mainly concentrated in the Gulf of Mexico, so none of the U.S. Arctic or Atlantic places where there was some talk this week about banning offshore drilling was ever really in anyone's near-term or medium-term horizon.
All right, so that's a regulatory side of things. What about oil prices? OPEC, of course, agreeing to reduce production. The big issue is whether we actually see compliance to those rules. How do you see oil trading, and what impact does that have on the drillers?
Right, so it looks like 2016 was characterized by a year of kind of 30 to 50 in that band. I think for next year, most of what we're kind of anticipating is that jump up to 50 or 60. A lot of that is predicated upon OPEC complying. We were modeling somewhere around a 75% compliance rate, even if production does average somewhere north of 33 million barrels per day in the first half of next year. You do get inventory drawdown starting in the second quarter, progressing through the third quarter, and then it gets a little bit hazy as you start to move through the back half of the year. They'll most likely have to meet again to keep production low. However, as time goes on and 2018 rolls on, there are risks of a surplus reemerging if they allow production to ramp back up to where they're at right now. So I think the first half of the year, the narrative is more or less constructive outside of some exogenous factors such as lower compliance or potentially Libya and Nigeria coming back, or potentially Saudi Arabia and Kuwait also increasing production from the neutral zone.
All right, good stuff. Thank you so much. Bloomberg's Andrew Cosgrove joining us from Princeton.
Coming up, what you need to know for tomorrow's trading day. This is Bloomberg.
And some breaking news from the CBOE. It says that Edward Tilley will take on the role as chairman and CEO. William Brodsky will be stepping down, and all this is happening because of the close of the BATS deal. So once again, William Brodsky, the chairman, will be stepping down. Edward Tilley will take on the role as chairman and CEO. Brodsky, Phillips, and Martin will actually all be stepping down from the board. That is William Brodsky, Susan Phillips, and Eden Martin. All right, in terms of what's coming up tomorrow, don't miss this. Vladimir Putin's annual news conference in Moscow starts at 4 a.m. Eastern time. It's actually supposed to happen this morning, but the funeral for the Russian ambassador to Turkey was taking place.
And at 4:30, I'll be looking at UK GDP.
And, of course, don't miss this. Michigan consumer sentiment and new home sales tomorrow at 10 a.m. Eastern time.
That's all for what you missed. Thanks for watching. This is Bloomberg.
I'm Courtney Collins, and you're watching Bloomberg Technology. Let's start with a check of your first word news. Syria says the strategic northern city of Aleppo has returned to government control. That ends a 4-year rebel hold over parts of the city. The army said it has reestablished security after the last holdouts evacuated the eastern parts of the city. The recapture of Aleppo represents a momentous victory for President Bashar al-Assad. In the U.S., President-elect Donald Trump is suggesting the military must, quote, greatly strengthen and expand its nuclear capability. Trump sent out a tweet the U.S. must bolster its arsenal until such a time as the world comes to its senses regarding nukes. Meanwhile, Trump named Washington insider Sean Spicer as White House press secretary. Hope Hicks will be director of strategic communications, while Jason Miller will serve as director of communications. Trump campaign manager Kellyanne Conway will serve as counselor to the president. And a vote on the UN Security Council resolution criticizing Israeli settlements in the West Bank has been delayed. That's according to the UN Media Liaison Office. Earlier, President-elect Donald Trump called the resolution unfair to Israelis, saying it puts them in a poor negotiating position. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Bloomberg Technology is next. I'm Caroline Hyde. This is Bloomberg Technology. Coming up, Alibaba's credibility crisis, the sequel, why China's e-commerce giant is back on the US blacklist. Jamie Dimon opens up. The JPMorgan Chase CEO speaks exclusively to Bloomberg and discusses dealing with disruption. And after another lackluster year on the tech IPO red carpet, a star-studded lineup eyes 2017 as the year to go public. But first, to our lead. A fair punishment or political power play. Alibaba is named on a US blacklist for featuring counterfeit goods on its Taobao e-commerce site. An embarrassing step backward for the Chinese company just 4 years after it was taken off the list. Now, shares of Alibaba slid in Thursday trading, with some analysts suggesting that the move was politically motivated, given heavy-handed rhetoric on China from the incoming US president. Alibaba CEO Daniel Zhang wrote to employees, quote, "We will not dwell on whether it was fair or just. What we need to focus on is how we improve and do even more. We also need to recognize that protectionism is ever present around the world, and influences that are not free market orientated come into play."
Joining us now to discuss those influences is our guest host for the hour. It's Bob O'Donnell, Technalysis Research, and in New York, Bloomberg technology reporter Selena Wang, who covers Alibaba. Selena, hit us with it. Just how embarrassing is this? Because in October, they took some drastic steps to try and reduce the counterfeit goods and tackle this very thing.
I think for Alibaba, this is really a big surprise. They've been off of this list for many years, since 2012. They say they've done everything possible to address all of the USTR's concerns, yet they're on the list again this year. I think for them, they see this as unfair. They think it's probably politically motivated, but there have been a rising number of complaints this year. We saw high-end brands like Gucci and YSL come out with a lawsuit earlier this year saying Alibaba was profiting from goods using their IP. There were also retail associations complaining, saying that the USTR should reinstate them. So the USTR is not saying that Alibaba hasn't tried. They're just saying it's not enough.
Bob, fascinating reading your own bio. You have been on lists of the most influential tech analysts out there. Are you one of these analysts thinking it could be politically motivated?
Well, I think it's a little early to say that. Remember, the Trump administration is not in office yet, right? So, you have to say, well, wait a minute. Given that, yes, there's going to be some influence toward that, but because it's before that, I think you have to look at the legitimate nature of the issue. And unfortunately, in China, the idea of using other people's IP to make products is rampant, and it has been. And I'm not saying that Alibaba is the culprit, but as the largest provider of goods through their Taobao store, unfortunately, they're just participating in what is a climate of copyright infringement.
How much do customers care, Bob? How much will this actually limit growth in here in the United States, for example?
Well, there are a lot of people who, in fact, specifically look for low-cost knockoffs of major brands. So let's not ignore that. But if I'm a major brand owner, of course, I want to be somewhat in control of that. And the situation you have with an Alibaba, as they continue to grow their influence, and of course they're trying to make a big statement and presence here in the U.S., the sense I think that the big goods brands are saying is we've got to watch this and monitor this closely. And if they're legitimately complaining, then I think the trade group has to recognize that and deal with the issue.
Selena, you look at how the shares have performed since the record-breaking IPO back in 2014. It's been a roller coaster ride. They're down on today. How much do you think this affects investors' desire to buy into this stock?
I think that it definitely does impact Alibaba. As Bob said earlier, realistically, this isn't going to hurt their business in China. But what this harms is their impact to go abroad, to be international, to really set themselves up as a big international brand. And this might harm Alibaba's own goals of reaching half of their revenue from outside of their domestic country. And in order for them to get all of that revenue outside of China, they need to gain the trust of international brands that they want to be on this platform. And let's not forget that Alibaba has plenty of competitors nipping at its heels. Some investors may see JD.com as a better growth value investment.
Bob, the winners here, is it JD.com that's also coming from China? Is it Amazon? Is it eBay, where perhaps you know that they're not so affected by this issue?
Well, I mean, I think Amazon is a potentially interesting winner in this particular case, because what we're seeing is Amazon, of course, trying to reach out into other places. Fundamentally, we're going to see a battle, a global battle for online e-commerce. And we're going to see players from both sides of the ocean in this particular case battling it out. And I think there will be people who take positions in particular areas and who can point to something as being critically important. So I think in the long run, there's some interesting opportunities for Amazon if they play their cards right. Mind you, it's very tough for them to compete in China. So we'll see. It may be that we end up with really much larger regional players and not that much global competition.
Selena, as Bob just mentioned earlier, Donald Trump isn't yet in power. The administration isn't yet there. This political climate that potentially the executives have blamed, is this going to get ever worse, do you think?
I don't think that it looks like the Chinese government we're hoping that Donald Trump's rhetoric would change when he was actually elected, and it wasn't just on the campaign trail. But the most recent weeks, especially with the drone issue this past weekend, have shown that those problems are likely to escalate. I do think it's important to recognize that what the executives are saying may just kind of be a scapegoat